All right, well, welcome everybody to a brand new week ahead. Now, we've got a lot to focus on in the week ahead. We've got everything from a whole list of political considerations that can create some volatility. We've got flow dynamics with month-end flows in play. We've got earnings with very big names reporting. And we've got a couple of very big scheduled risk events, 3 central bank decisions, and a whole lot of data. Now, not everything will, in my opinion, be important this week. A couple of data points will be interesting to watch, but there's only going to be a real small handful of very key events that I'll be spending most of my time on, and that's the one that we'll be discussing in detail in today's video. Now, just as a quick heads up, what type of things do we need to watch for in the week ahead? Now, from a data point of view, we'll touch on that in a second. Let's maybe start with the political stuff. There's a lot of political stuff to watch. Monday and Tuesday, we have continued trade talks between China and the US. The idea around these discussions between Monday and Tuesday is for the two sides to broker some type of agreement to push out the August 12th deadline that they have for reaching a possible agreement or deal. Now, everybody expects both sides to be able to fairly easily push that date a little bit wider. There has been previous things touted that seems to be on the card. So if we get that, that shouldn't be really something the markets focus on. But because everybody thinks that we will get an extension, if there's a massive breakdown in talks between Monday and Tuesday, that will of course be something important for the markets to watch. And if we do get a massive breakdown in trade talks, we would expect that to hit risk sentiment, with things like equities potentially taking a hit on the back of that. So that's something to watch. The other ones we have coming up, which will be difficult to plan for and very difficult to trade, will be Thursday and Friday. Thursday, we've got two things. Firstly, we have the US courts that is set to begin deliberating over the legality of Trump's tariffs. That thing can linger for quite a while, right? So we don't know what's going to happen on Thursday. It only starts on Thursday. It's probably not going to lead to any type of conclusions this week already, but it will be something just worth watching as headline risks. The other one will be, obviously, last week we had Ishiba, the upper house election in Japan, where PM Ishiba, they didn't win the majority. They lost the majority with 3 seats. And what that means is that, his job is potentially up for grabs here. Normally, if the ruling party or majority lost the upper house election, normally they would see the leader of that, the PM, would step down within a month or two after losing the majority. Now, there was some comments last week saying that he is going to resign, which sent the yen lower. And then immediately we heard comments coming in later saying, no, he actually didn't plan to resign. The news is fake news that it's going to resign, and that sent the yen higher again. So if we get any type of developments on that front, that's going to be important to watch. As a very broad way of looking at it, if he stays in power, that should be positive for the yen. If they kick him out, that should be negative for the yen because it forces some political uncertainty. So that's just something worth keeping in mind as well. The other thing that we need to watch on Friday, and obviously this leads into Friday really for the majority of the week, is any type of trade developments, because the extended deadline for the Trump tariffs is on Friday, the 1st of August. Right, so we are probably going to hear from a couple of potential trade deals, maybe some reached trade deals. We obviously had the trade deal with Japan announced last week. That's going to be in focus this week. The problem with these types of things, which is why I'm not really going to be planning to trade any of these things quite aggressively, is because there's just no way to plan for it. We don't know what's going to happen. We don't know what's going to be said. We don't know whether we're going to get agreements or potential deadline extensions. There's just so much that can happen, and there's very little way for us to really hedge ourselves against that because we just don't know which way it can go. So that's going to be things to watch. It's not something that I'm looking to potentially trade. It's just something worth keeping in the back of our minds. The other thing that's worth keeping in the back of our minds is this week is, of course, the last trading week of July. What does that mean? It means expect month inflows and corporate month inflows to hit the wires. Now, there hasn't really been a lot of previews available for this over the weekend. The one that I did see from Credit Agricole expects very marginal dollar selling due to month-end rebalancing, and they're also expecting some potential euro corporate buying against euro corporate dollar and pound selling. So they are looking for some euro dollar and euro sterling upside on the back of corporate demand this week. Now, you guys know how I feel about things like month-end flows. It's good information to have. It's near impossible to try and make money with it. So just keep in mind that if you were to see some pretty weird and erratic moves taking place around that London fix, which is 4 p.m. UK time, it might just be down to pure and simple month-end flow dynamics. Not something that you can really plan for, not something that you can really look to trade, just something worth being mindful of as you approach your trading sessions. Now, let's get into the stuff that we can actually plan for or that we do have on the schedule. Now, one that's just worth noting is earnings. Monster names reporting this week. On Wednesday after market, we've got Meta as well as Microsoft. On Thursday after market, we've got Apple as well as Amazon. So huge tech names releasing on Wednesday and Thursday. Why is it always important to keep these names in mind, even if you don't trade these names individually? Is because if we have massive moves in these names, because of their weighting, their giant weighting that they have in the big indexes like the S&P and the Nasdaq and the Dow Jones, if we get really big reactions out of these individual names, it can impact the broader index, and whatever happens to the broader index will have a spillover effect into other markets like FX, like the bond market. So we need to pay attention to these big names, these big earnings, because they can have an impact in other markets as well. Other names just to be aware of, also from a weighting point of view, more so on the Dow Jones side, would be Boeing coming in at a close to 5% weighting. We also have names like Visa. We've got names like Procter & Gamble, names like United Health. All of these things will be worth watching for those of you that are running exposure in the Dow Jones. Now, let's get to the regular calendar then. And look, there's a lot going on this week. We've got 3 central bank decisions. We've got the FOMC, we've got the Bank of Canada, we've got the Bank of Japan, we've got Aussie quarterly CPI data, and we've got a whole string of other data points. We've got flash CPI data coming out for Europe. We have GDP advanced reading coming out for the US. We've got all of the regular US jobs data that feeds into NFP. And then of course on Friday, we've got NFP as well. Now, the good news is I don't think all of these things will be particularly tradable. I think there's going to be a few that's worth watching, but there's only going to be a handful that I think can provide us with some pretty decent reactions. Now, let's quickly touch on the 3 central bank decisions first. Now, we mentioned we've got the BOC coming up on Wednesday, and we've got the Bank of Japan coming up on Thursday. Now, these two, the markets aren't expecting anything massive from these two banks. If you take a look at rate expectations right now for the BOC, the market is very comfortable that we're going to get a hold from the bank coming up at this meeting. There's also not even half a cut priced by the end of the year for the BOC. Why are the markets so sure that we're not going to get any type of movement from the bank this week? Because of tariffs. Nobody knows what's going to happen with the US's relationship with Canada until we know what's going to happen, right? And until we do, and we will be getting some information from the bank in their monetary policy report about how they think tariffs could potentially be impacting the economy. But even that is going to be, it's a what if scenario, right? If this happens, then we think it could have this impact. There's just no way of knowing. If you take a look at the recent data, inflation for Canada, at least the bank's preferred measure of core inflation, is still sitting very close to that 3% level, which means that it has been a bit more sticky. The recent jobs print we had was much better than what anybody expected. So there's very little reason for the BOC to change anything this week. Very little reason for them to say anything new this week, which is why we think it's going to be, there's a higher probability that this is going to be a dud. Now, what about the BOJ? When it comes to the BOJ, markets are, again, fully expecting a hold. And if you take a look towards the end of the year, the markets are almost pricing in one hike by the end of the year. Almost. Now, the reason why the markets are more comfortable with pricing in a hike than not is because we heard on Friday from the bank that there are still they still see this as a hike potential year, if you will, where they do think there could be scope to hike rates, but they clearly said that they think they will only have enough data to do so by the end of the year. So nobody's expecting them to change their language this week. Nobody's expecting them to do anything new. They did back in June obviously say that they're going to lower their JGB purchases, which was a form of tightening in itself. So after that, and obviously with all of the political uncertainty right now after the upper house elections last week, there's very little that the markets are expecting from the bank. Now, this is the Bank of Japan we're talking about. They love playing and toying with the market, saying things and then doing another, and vice versa. So be careful with it. There could be some volatility, but personally, I wouldn't touch Bank of Japan policy decisions with a 30-foot pole in terms of tradable opportunities. It's just a complete mess most of the time. So just be careful with that. The markets aren't expecting anything major from that. Now, in terms of the FOMC, now, most people are expecting the FOMC to be a bit of a dud as well. I do disagree a little bit though. What are the markets expecting? Look, markets are expecting a hold from the bank with a close to 100% probability, and I totally agree with that. The Fed, unlike many other central banks, they don't like surprising the markets. So what you would expect is if the markets are pricing in more than a 60% chance of the Fed doing something, they will most of the time follow through with that. So everybody's expecting a hold. Where the main focus will come from, though, is how aggressive will the Fed's language be about potential further cuts, right? Recent data has been solid enough to buy the Fed more time. We had the June CPI numbers ticking up or moving in the wrong direction, which is higher. We had non-farm payrolls, which was stronger than expected, even though private sector hiring did soften. Overall, the data was fine. If you look at the labor market, if you look at inflation data, there's no reason for the Fed to make any rash decisions. Also, the Fed won't have the July NFP or the updated PCE data in their hands. The data won't be officially released. They will probably have eyes on the data before we do. And this is really where the kicker comes in. This is why I don't agree that this meeting could just be a complete nothing burger. Because if we would assume they would have seen the data by the time that they have their decision on Wednesday. And if they do, for whatever reason, tilt a lot more hawkish or a lot more dovish than what the markets are expecting them to, that can give us a fairly decent insight into what the PCE and the NFP data might be showing us. So for example, if they come out surprisingly dovish, opening the door more firmly towards a potential September cut, the markets are currently sitting at 64% probability of that. So if the Fed comes out and they are more stern that, yeah, we are going to be cutting rates in September, that could be telling us that maybe PCE data is priced lower, or maybe the NFP data came in with a big miss. If they, however, come out a lot more hawkish, maybe that is their way of, maybe that's a way for us to see that, okay, maybe the data actually came in solid for PCE as well as NFP. So I do think NFP could potentially be market moving if they surprise. Now, again, majority of participants don't expect them to say anything new. But I think the fact that we wouldn't have the data by the time they make these decisions, but we do know that they normally have access to the data, that could give us some unique insight into what that data might be showing us based on how the Fed reacts, based on the type of outcome that we get. So what are the possible triggers then? If we get a dovish surprise where they, like I said, strongly open the door to a cut for September, the markets are only 64% priced towards a cut at this stage for September. So if they do come out and they say, yeah, we're probably going to be cutting in September, the markets will need to reprice that quite aggressively. If we get that type of reaction, you would expect that to weigh on the US dollar. You would expect that to create downside pressure for the likes of the US dollar, and you would expect that to create upside pressure for the likes of equities, right? Now, what if they come out and they are a lot more hawkish, right? What if they strongly push back against the idea of near-term cuts, saying that we are nowhere close to that? We see no reason to change our previous view. If they push back really hard, then maybe that shows the markets that maybe the data came in a little bit hotter this week, and that could lead to some short-term downside pressure. for the S&P and obviously upside pressure for the US dollar. Keep in mind that equities are trading at all-time highs, and we will be going into things like earnings. So seeing some profit taking on that type of decision wouldn't be a surprise to see a bit of a stronger pullback in the likes of the S&P. Also, when you consider things like positioning on the dollar side, we know that the dollar is still fairly close to stretch short territory here. So if we were to see a more hawkish Fed, that could see quite the upside reaction in the likes of the US dollar. So that could definitely be something worth watching in the week ahead. I think if we do get a surprise from them, that gives us some unique information about what the economic data, or at least the outcome of that data, would be going in later in the week. Now, apart from that, the other ones that we'll be watching quite closely is Wednesday's Aussie CPI data. Why will the CPI quarterly number be important? Because this is the one that the RBA said they wanted to see before they make a decision on rates going forward. Now, if we take a look at where this data currently sits, let me just get that chart up here for us. We know that the quarterly prior number sits at 2.9. We also know that the annual trim is currently sitting at 2.4. That's like your regular one that we get on a monthly basis. And the weighted average is sitting at 2.1. Now, what the bank told us is that, they're not comfortable at 2.9 to be cutting rates. They want to see this blue line, the quarterly trimmed year-over-year CPI. They want to see that drifting closer towards the mid-range of that, closer towards 2.5% basically. Now, what makes this interesting is that last week, we heard Governor Buller come out and say that the Q2 number, there's a risk that the Q2 number isn't as soft as they previously thought it would be. Now, they previously thought that the quarterly number will be sitting at around 2.6%. So for them to come out and say that, it means that potentially that number is closer towards 2.8, maybe 2.7%. Now, if you take a look at market expectations here, markets are currently pricing in a 2.7% print on that trimmed mean year over year. So the best case scenario for a trade for us on either side of this would be for this to come in much, not just below 2.7, but below where the bank thought it would be initially, which is below 2.6. If we see that, if we see a 2.5 or something close to that or lower print for the trimmed mean, I would expect quite a lot of downside playing out for the Aussie dollar. There is a risk to this view, which is positioning, because if you take a look at positioning, we can see the markets are very stretched short the Aussie dollar right now. And we can see the markets are already fairly closely priced towards a cut for August anyway. So why would I expect downside for the Aussie if we get that? Because we saw the Aussie push up on the back of that pushback from the RBA, but we haven't really seen the Aussie lose a lot of steam, right? We actually saw the Aussie recover fairly decently. If you take a look at the index, the Aussie index, since we had that meeting, the Aussie has just been pushing to the upside quite decently, right? So I think even though positioning is still stretched on the short side, if we see that CPI number surprise to the downside, that's going to see the market saying that, you know what, this bank is behind the curve. They should have cut rates 2 weeks ago when they could have. They stayed too patient. Now they're going to have to cut a little bit more aggressively because it's just the quarterly CPI data that's keeping them away from cutting rates again. So even though positioning is stretched, even though the markets are fairly close to fully pricing in a cut anyway, I would still expect decent downside for the Aussie if we get a decent miss. Now, the pair that I'm currently already priced or currently trading with that view in mind is the Aussie Kiwi, and I would expect decent amount of downside if we do get a big miss. Now, having said that, for all the opposite reasons, because things like copper prices have been pushing up, that's the orange line, and we know the Aussie is positively correlated with that, and because of positioning being so stretched on the short side, if we were, for whatever reason, to get inflation coming in much hotter than expected, let's say something closer towards that prior 2.9 number, showing no deceleration in inflation, that could see the Aussie pop fairly decently as well. So it's tradable in both directions, but I think the easier trade would be to hope for a miss and to trade that in line with the market's broader view for where they see the RBA taking rates, and that is lower, right? Trading the Aussie higher on a beat could be good as a short-term trade, but for something that's got more medium-term potential, you want to see this coming in lower, which feeds into the market's expectations that rates will be going lower in the medium term as well. And that just feeds into that possible policy divergence between the RBA, which is busy ramping up their cutting cycle, and the RBNZ, which is currently looking to wrap up their their cutting cycle with just one more cut. So the RBA is just starting to cut rates, while the RBNZ is starting to wrap up their cutting cycle, which in my opinion still means downside risk for a pair like the Aussie Kiwi. So that is one to watch for sure. Definitely one of the more interesting ones to pay attention to. Now, throughout the week, we're going to get a lot of employment data that feeds into NFP. We've got the JOLTS data coming up early in the week. We've got the ADP data coming up early in the week. And all of these things feeds into that NFP number on Friday. Now, even though individual surprises in the JOLTS and the ADP can be market moving, I don't think they're going to be particularly tradable, because the markets will be going into the NFP, into the FOMC before we get that data. The markets wouldn't want to trade those data points going into FOMC. And after the FOMC, the markets will want clarity on the data and wait for NFP anyway. So I'm only going to be focusing on NFP. I'm not going to be looking to trade those smaller data points like GDP, ADP or JOLTS data. I'm only going to be focusing on the NFP. Now, in terms of NFP expectations, as usual, the forecast distribution is massively wide. You've got people expecting a 0 print, while others are expecting 170,000. There's a huge distribution here. As usual, I'm going to wait for the data and trade it. Because of the way the markets are set up right now, I am hoping that the Federal Reserve comes out and they make no new changes, right? I'm hoping that they are not overly dovish or overly hawkish. They basically just stick to the same script. I would expect that as a baseline to create some upside pressure for the dollar this week. The reason for that is the market is massively short the dollar right now, and even though things like month inflows can pressure it, the recent data has shown us that the US economy hasn't taken the hit that so many people expected it to, right? Unless we see massive disruptions on the trade side, as long as the Fed doesn't sound dovish, I would expect that to create some upside pressure or potential for the US dollar. And because positioning is still very close to stretched, and because the markets have been so very negative on the US dollar for such a long time, and a lot of those negative things haven't really played out that many people expected, if we get a really solid or another solid jobs print, that should kind of just seal the deal that, you know what, things aren't really that bad in the US. There is more scope for the dollar to recover. And that could also see the market starting to price out that 60% probability of a cut for September, right? That could see that flipping sides. We could see the markets pricing in a higher probability of a hold as opposed to a cut, and all of that should be positive for the US dollar. Again, if the Fed does come out and they are dovish, that is obviously some downside risk for the dollar. But at this stage, I'm very reluctant to short the dollar just because of a slightly more dovish Fed, because there's so much negativity already priced in for the dollar. I would only prefer to trade it higher on good news. I wouldn't prefer to trade it lower on bad news. That's just me. Doesn't mean that that's something that you have to do. That's just the way that I'm approaching the dollar going into the week ahead. The other thing just worth keeping in mind about the Fed, right, is that the markets are expecting some dissension in the ranks. What do I mean by that? Remember, we had Governor Waller as well as Bowman. Both of them came out recently in their communication saying that they are looking for voting for a possible cut, or they are open to voting for a cut at this meeting because of a lot of reasons. Inflation is actually slowing, the labor market is slowing down, yada, yada, yada. We all know why they are dovish. Both of those two candidates, or both of those two people or governors, have been touted as possible people that might replace Powell. So both of them are just gunning for the job, right? Both of them want to get into Trump's good books by saying super dovish things while all of the other colleagues are staying more hawkish. That's the only reason, in my view, why they are saying those things. And it's very political. It's very irritating, in my opinion, because these guys shouldn't be making political decisions, but they are making political decisions. So just keep in mind, there might be some initial dovish reactions if those two FOMC members actually vote for a cut. But the markets, in my opinion, should be able to look through that fairly easily because everybody knows they're dovish. They've told the markets that they are looking to potentially voting for a cut. So if they do vote for a cut, it shouldn't be a medium-term negative driver for the dollar, but it can create some short-term negative gyrations in the likes of the dollar. So that is just something worth keeping in mind. Broadly speaking, though, as long as NFP comes in fairly in line with expectations, I would expect that to create some marginal upside pressure for the US dollar, and I would look for a possible beat in NFP to just see the dollar extend further to the upside as it shrugs off some of that negative positioning that's still pretty much in play for the US dollar over the past couple of weeks now. So it's a very busy week ahead, but just to summarize the key events to watch out for that we can plan for, at least with the FOMC, the Aussie CPI data, and then NFP coming up on Friday. And then obviously keep an eye on those flow dynamics with month-end flows. Keep an eye on earnings, what happens to equities, and obviously keep an eye on those political considerations with a lot of trade news expected for the week ahead. So with that said, as always, if there's any questions, don't hesitate to let me know, and I hope everybody will have a fantastic week ahead.